Good morning, everybody, and welcome to our April webinar. This webinar today is going to be on the new PCG guideline on professional practice structures and obviously focusing on what the Commissioner's view of them are and how that may impact both your professional clients and your own structure if you're one of the accountants that regularly watch us who are business owners themselves. The presenter who will join a little bit later today will be Paul McEnroth from our Brisbane office. Many of you will have seen Paul present before. In terms of the presentation today, he's happy to take questions during the presentation. You'll find over to the right of your screen a chat box where you can ask a question. I should have introduced myself. My name is Adrian Bailey. I'm from our Sydney office. I'll be moderating the webinar, so fire in your questions when you feel like it or comments. And at an appropriate time, I'll break into Paul's presentation and ask him the relevant question. A reminder on that and questions generally, this webinar is recorded and will be uploaded to our website a little bit later on. So obviously in terms of those questions, if you could not have client details or anything like that in them, just in case. Other functions of the software, over on the right-hand side of the screen, you should see a Files button. If you'd like to download the presentation from today, you can do so by clicking on that and downloading the slides. Later on today, after the webinar is over, you'll also be getting a feedback email in relation to today's event, which you can also download the slides if you don't get a chance to during the presentation today. Speaking of events, we are continuing to hold these webinars monthly. Just so that you're aware, our next webinar will be on Friday, the 21st of May, slightly earlier. It'll be half an hour earlier than the ones we've been running at the moment due to some other things that we've got on the day. And the topic on that day will be property development, having a look at property joint ventures, capital, whether the clients are in the business of property development or whether it's a capital receipt. So that will be, keep an eye out for the invitations for that, but that's Friday the 21st of May. We've also in May got our face-to-face workshops. Now Brisbane and Sydney are now fully booked. We've still got 4 seats left for Perth on the 12th of May if you're in WA, and the Gold Coast still has about 20 seats left if you're on the Gold Coast and watching this and haven't registered yet. And again, in our feedback email today, we'll be sending out a link to the Perth and Gold Coast workshops if you'd like to register for those face-to-face events. Like all of our events, they are at no cost and no so feel free if you'd like to have a look at the events to register and come along on the day, and we'll be looking forward to seeing you in person. So I'm going to throw over to Paul now, who's going to start the presentation. Yeah, that's it. So thanks, Paul.
Well, thank you, Adrian, and thank you, everyone, for coming along to listen in to what I have to say about the Commissioner's new practical compliance guideline, which is still in draft, but obviously it's about their compliance approach to professional practice structures. This PCG, when it's approved, will likely affect business owners on this call today, purely because it's directed at people like you and us, accountants, lawyers, and other professionals, as opposed to other industries, so to speak. And I think it's pretty safe to say that this practical compliance guideline has had some fairly widespread criticism from both our industries, the legal and accounting world, and in large measure due to its perhaps discriminatory nature, that it attacks something or legitimate transactions that we as lawyers or accountants might do in our businesses, which don't apply to other industries, certainly not to the same level of scrutiny. So there's been a long history of ATO attacking professional firms and for what they've seen as, I guess, mischief in how those professional firms allocate their income. It goes all the way back to 1978 in Phillips's case, where they were attacking the use of service trusts. It then went through the 80s, where the Commissioner was upset about certain arrangements where partners in a partnership assigned their income to family trusts. And there were two main cases there which are reflected in the PCG, Everett's case and Gallen's case. Both were about the assignment of an interest in partnership profits. The first case being the authority that you can assign your interest in partnership profits. And the second case, Gallen's case, was more a timing issue. If the assignment was on the 26th of June, was the assignment effective for all of the year's profits, or simply from 26 June to the end of the year? And as we know from Gallen's case, a partnership profit is struck at 30 June, so therefore the assignment was effective for the entire year's income. In 2014, we fast forward a little bit to 2014, they released guidelines on the allocation of profits. And from there were, and we will talk about them in a little bit more detail, those guidelines set in place some safe harbour provisions, which most of us would be aware of. And if we stuck within one of those safe harbour provisions, we felt comfortable that the Commissioner wasn't going to, devote compliance resources to that business. In 2017, the Commissioner suspended those guidelines and said that he was looking at, redeveloping his position on what the guidelines should be. It took 4 years for the Commissioner to come out with a draft ruling, which provides for a new and more complicated era for professional services firms. So, as we would know, the suspended guidelines established 3 safe harbours. Firstly, the 30% effective tax rate, or the 50% individual share of income, or a benchmark salary effectively. And excuse me, I may unfortunately do that a little today. I've got a bit of an asthmatic cough at the moment, so I apologise for that in advance. So within those safe harbours, if we satisfied one of those safe harbours, we were a low risk in the eyes of the Commissioner. And I guess those 3 safe harbours were quite easy to understand. If we had a 30% effective tax rate from our professional practice income, we were within the safe harbour. If the individual who was in the business, say it was a partnership of individuals, well, if that person received an individual share of 50% of their entitlement, or their group entitlement, using that word group loosely, then they were within a safe harbour and low risk. Or if they received income comparable to a senior employee's remuneration, then they were within the low risk category as well. Again, satisfaction of one of those areas was sufficient. So we might look now at what a PCG is. Well, the first thing is it's not a ruling and it's not the law. What it is a guideline to the ATO staff about how they should review certain matters. And in this case, obviously, the allocation of profits from professional services firms. This PCG is about the circumstances where the Commissioner might apply Part 4A to a scheme. So there's obviously an understanding there that the allocation of profits might be perfectly reasonable, but for Part 4A. So it's about telling the ATO staff, well, this is the methodology we want you to use in order to determine whether or not the Commissioner might apply Part 4A to a particular scheme. So there's a number of prerequisites in order for the PCG to apply to you or to your practice. And that is the IPP, which is the individual professional practitioner, and you'll see that phrase used a fair bit. They must provide professional services to clients of the firm. they and their associated entities, so trusts or companies, have legal or beneficial interest in the firm. The income of the firm is not PSI. Obviously, if it is PSI, it's not within the, you don't have the ability to necessarily income stream. There must be a legally effective structure in place. An IPP is an equity holder in the business and holds full rights to participate in the voting, management, and income of the firm. The arrangement must be commercially driven, and you'll see that phrase used a fair bit. And the second one, that the firm and the IPP do not demonstrate any high-risk features, and they have defined some of those in the PCG. So again, who has access to use the somewhat complicated formulas? You must hit. You must be within both of the two gateways they've identified in the PCG. So the first gateway being there must be a commercial rationale for the structure or the transactions that have occurred, and there must be no high-risk features as they've outlined. So gateway 1 is commercial rationale. So the Commissioner wants to see a genuine commercial rationale for the arrangement where income is derived by an IPP or their group. The legal form and the documentation must be consistent with the economic substance of how the firm works, and having appropriate documentation in place will be critical to the Commissioner's decision as to whether he believes there is a commercial rationale for the transactions that have taken place. This table is taken from the PCG. I won't go through it all, but it outlines some indicators where there is a lacking of commercial rationale or where there are indicators of a genuine commercial basis. Obviously, if an arrangement is complex, has many steps that serve no other purpose other than to derive some tax benefits, then those kind of arrangements, particularly if they're not arm's length, which often they won't be, those arrangements, the Commissioner says, lack commercial rationale. Conversely, if there are indicators where there is a genuine commercial basis for the transaction, the Commissioner is less likely to consider that or more likely to consider that you've satisfied Gateway 1. And a few of those are, some of the ones that jump out at me are loan accounts and whether the people who have loan accounts in trusts, for example, actually aware of those loan accounts, or are they unaware completely? Distributions, are they paid or kept by other people? So, things that we're used to questions from the Commissioner about, as particularly in the context, say, for Section 100A, whether adult children are even aware that they've had a distribution other than perhaps a little bit of extra tax that they've paid on account of mum and dad. So Gateway 2 is you can't have any high-risk features. Now, the Commissioner outlines what he sees are high-risk features, and that is if the scheme or arrangement is the subject of a taxpayer alert. Now, that may be a taxpayer alert in the past or even in the future. So if new taxpayer alerts come out and you sit within that taxpayer alert, then the Commissioner will consider that is a high-risk feature. Some of the next bullet points we're going to talk about in a bit more detail, so I'll go through those on the next slides. But essentially, the next high-risk feature is essentially a financing arrangement that is at not arm's length. Okay, the example the Commissioner gives, which I find a bit distressing, frankly, that this is said to be a scheme to which Part 4A might apply, is that an IPP disposes of a portion of their interest in a professional firm to an associated discretionary trust. which has to borrow money from the bank to pay for the transaction. The Commissioner essentially is, what he doesn't like about this transaction is that money might be paid to the individual who pays down a non-deductible debt, so a home mortgage, and the discretionary trust has a deductible debt and has purchased a partnership interest. Now, I can't see that that is a scheme to which Part 4A should apply to. It may apply, but that to me seems like a fairly ordinary transaction, which frankly should sit outside of Part 4A. However, it doesn't consider at all what was said in Purcell's case, which is that the transfer of was a partnership interest in Purcell's case to a trust for the benefit of others is a transaction for that purpose, not necessarily for the purpose of deriving any particular tax benefit. Perhaps if the discretionary trust distributed income to other persons, and that money was then used or not paid to those persons and used to pay down the debt, perhaps that may be a further circumstance to help the Commissioner. But for mine, this is a fairly usual transaction where you're looking to dispose of an interest to a discretionary trust. So it's something to keep in mind, but we'll need to consider those sorts of transactions a little more closely in these contexts. The next one is, to be honest, a fairly ordinary example in that I would think Part 4A would apply in the ordinary circumstance anyway, outside of having a PCG. So this is where an individual non-equity partner has a fixed draw, which is akin to it, which is really in the nature of a salary, albeit that they call themselves a partner. They're not an equity partner. Their draw, so to speak, is essentially a salary. That is not something that you can assign under an Everett assignment because it is personal services income of that person. So that to me is a fairly straightforward example of when Part 4A would apply to a particular circumstance. The next one is one that lots of people use regularly, and that's a dividend access share or dividend discretionary unit in a unit trust, for example. The Commissioner is obviously targeting here where the payment made on that discretionary dividend share or unit is really a payment of that person's salary. It has no correlation to the profits or even an entitlement of the IPP under the trust or the company. It's really a way for the IPP to take less salary and distribute some of that salary via a discretionary dividend share to a family trust, for example, and then distribute it to other beneficiaries. Again, that sort of circumstance, I think, would fall within Part 4A now, but it is one of those high-risk features that the Commissioner is, I guess, targeting in this PCG. So once we've determined whether we fall within Gateway 1, that is, we have a commercial rationale for our arrangement, and Gateway 2, so we need to satisfy both, and Gateway 2 is that we don't have any high-risk features. We then have the ability to use this risk assessment scoring table. And this is where the complexity and I would say yearly look at our circumstances needs to take place. So there are three risk assessment factors you need to consider. The first is the proportion of the profit entitlement of the whole firm that is returned in the hands of the IPP. And you'll see the scores across the table. So if we've got less than 90% of the profit entitlement of the whole firm is returned in the hands of the IPP, we get a score 1. And we work our way down to if the profit entitlement from the whole group returned in the hands of the IPP is less than 25. The first one should have been higher than 90. So higher than 90 and less than 25, we get to a score of 6. Now that first part is not 90% of the firm's income. It's 90% of the IPPs and their group entitlement to firm income. So, and we've got some examples. So if I have 50% of the units and I receive 90% of the income on my 50% of the trust income, then I would have a score of 2 in that circumstance, because it is 75 to 90. So anyway, the examples will make that a little bit clearer, hopefully. The second one is coming back to that total effective tax rate of the IPP and their group. So if the effective tax rate is greater than 40, obviously we have a score of 1, and we work our way down to under 20%. The third risk assessment factor is the remuneration in the hands of the IPP as it relates to a commercial benchmark. So you can see that there are similarities between the old suspended guidelines and the new table. It's probably the fact that you need to pass through gateways 1 and 2, and you need to satisfy essentially all 3 of these being low risk before you can determine if you are in fact low risk. So we need to yearly go through this process whereby we make an assessment of each risk assessment factor, applying a score to it, and when we tally that score up, we get to determine whether we're in the green, amber, or red zone. So again, risk assessment factor number 1 is the income return to the IPP. If you have the IPP receiving 100% of the income entitlement, then they automatically sit in the green zone and you don't need to worry about any other risk assessment factor. So if my entitlement to 50% of the firm's income, and I take in my salary, my distribution and return it in my tax return, 100% of my 50% entitlement, I'm in the green zone and I don't need to worry about anything else. Obviously, that's what the Commissioner would like. So there's no income splitting. I take all of the income. That will work for some people, but on the whole, that is not in practice how most professional services firms are structured and operate. It will include group entities and group income, and include service entities in that total. The PCG is a little bit loose on that language as to when it will apply, but it seems to be if you have a service entity that is connected to the main professional practice, then the income of that practice will be included. The second risk assessment factor is the effective total tax rate, and essentially there is a formula based in, and in the examples you'll see how this is broken down, but essentially the total tax paid by the IPP and their associated entities on the professional firm income, which will include those service entities. And you divide that by the total firm income collectively received, multiply by 100, and we get our effective tax rate. Risk assessment factor number 3 is the IPP remuneration. So this is our benchmarking. And it is up to the individual taxpayer as to whether they think they can determine what an appropriate remuneration is for I guess, their role. But there are a couple of different avenues for determining that. Essentially, employees within the firm who are on commensurate duties, employees or principals in comparable firms, relevant industry benchmarks. I would think the first one is probably the one that most people will use. Number two is probably unlikely to use because it is a bit of apples and oranges in all firms. And three, perhaps there might be some relevant industry benchmarks, but I would think, it will be that first one, employees within the firm who provide commensurate duties. So your most senior accountant or your most senior lawyer, what is their income, and how does that compare to the IPP?
Hi, Paul. Just to break in before you move to the next slide, just a couple of questions for you. First of all, are Everett assignments still valid?
Yes, they are. There is no issue, and this PCG doesn't take issue with Everett and Galland assignments. The Commissioner accepts that they are effective. What the Commissioner is identifying are arrangements where they are attempting to mask a transaction that as a Galland assignment or an Everett assignment when they're not actually that. So you're doing an Everett assignment on your PSI, for example, which is essentially what the example is about. So in short, yes, they are.
And just a couple of questions on the grouping, if I could use that phrase. Would the group include a bucket company?
No, it would. It is about the professional practice firm income. So a bucket company essentially is it will be included in the total effective tax rate because it may receive a distribution of income from the professional practice. But what we're comparing it to is the professional practice and the service entity.
Okay.
The PCG doesn't really explain it that well, but that's my understanding of it. It's really about working out in that year what are the entities that provided the services to the client. The bucket company wouldn't be one of those.
Okay. Two more to go. What about if the associated entities have business expenses or deductions, for example, interest on loans, which reduce the overall tax rate?
I don't believe, and I can come back to you on this specific question. I don't believe those factors do come into it. It's a fairly bland. Formula, but I can come back to you on that question.
Okay, and just the last one for now. For risk assessment factor 3, does remuneration include funds received as dividends rather than salaries?
Yes, it will. It's about how much money is returned in the hands of the IPP. So it doesn't matter whether it doesn't have to be salary. What they're saying is your remuneration as a matter of assessable income that has come from the firm, is that commensurate with the most senior accountant in your practice?
Thanks, Paul. I'll let you get back to it.
Thank you. So once we've gone through that process of determining each of our risk assessment factors, we get a score for each one, and then we add them together. Now, they've allowed circumstances where the first two factors are the only two that are satisfied, and a third one for where the taxpayer reasonably, that's open to challenge by the Commissioner, but if the taxpayer reasonably determines that the third factor, being the commensurate remuneration, is too difficult to determine, then you can go on the aggregate scores of just the first two. I would think most accountants, certainly most lawyers, the aggregate of 3 is where we're going to sit. So if when we add up all the scores, we have a score of less than or equal to 10, we sit in the green zone. The amber zone is 11 and 12, and the red zone is obviously 13 or higher. So when towards the end of the paper, we're going to look at, well, what does that actually mean from a compliance standpoint and from an, I guess, a auditing standpoint. But we'll look at some examples, and because I'm a lawyer, not an accountant, I cheated and took these examples from either the PCG themselves or from a little cheat sheet sent out by the Tax Institute. Because whenever lawyers start playing with numbers, and if you find an error, I'm happy for you to email me through. But whenever lawyers start playing with numbers, we usually stuff them up. So unfortunately, these examples are a little bit bland. But what I would probably highlight is these are quite friendly examples to the Commissioner. So in this circumstance, we've got the firm at the top, and the IPP, or their group, so to speak, has an entitlement to $600,000 of firm income. In this scenario, Nicholas will receive 55% of the entitlement, and a company will receive 45%. So when we look at risk assessment factor number 1, Nicholas returns $330,000 or 55% of the profit entitlement, and that gets us a score of 4. However, under the suspended guidelines, you would know that he's received more than 50% of his entitlement, and under the suspended guidelines, this would have been considered low risk, and no other test would have been would need to be satisfied. However, under the new PCG, we need to satisfy all 3, or we need to get a score for all 3 and add it up to see if we get a green zone. So when we look at the effective tax rate, Nicholas paid tax on tax of $119,000. The company at a tax rate of 26% paid $70,000. So you'll see the formula there as it is worked out, and we get a total effective tax rate of 31.56%, which sits in that happy zone and gets us a score of 3. Again, our 30% tax rate on the suspended guidelines, this would have been a low risk and no need to assess under any other category. The Commissioner, for whatever reason, chose to say that under this example, there was not a practical way to work out whether Nick's entitlement or his $330,000 was appropriate. So we're going on just the 2 factors, 1 and 2, and we get a score of 7 by adding those 2 together, and we sit within that green zone. So example 2, we've got again a firm entitlement of $600,000 to the group, and we've just jigged it up a little. So Nicholas is still receiving 55% of the firm or the entitlement from the firm. We've got some children, a spouse, and a company receiving some part of that entitlement. So again, we've got a risk assessment score of 4 for Nicholas receiving over 50%. When we look at the total effective tax rates, again, we add up the tax that was paid by each of the parties who received an entitlement from the firm, and we divide that by the amount of the firm entitlement that was owed to them. And we end up with a 31.37% effective tax rate across that group, and a score of 3. And in this scenario, Nicholas has determined, actually, sorry, I've got the wrong part in that application. What we've said in that is that Nicholas has determined that he is receiving between 100 and 150% of the benchmark rate for his I guess, entitlement. So that gets us a score of 3. And you can see there, when we add them up, we have a total of 10, and that sits us again within the green zone. Probably the points that are made here that I would make on the first couple of examples are, one, that, as I said, they are quite simple examples. When the firm entitlement reduces below 600,000 to, say, for example, 300,000, risk assessment factor number 2 becomes harder to satisfy, and the scores go a lot higher. And that's just a factor of a number of things. Basically, the total tax paid by each individual member is going to drop, and certainly when we, when we drop below that 30% effective tax rate, our scores go up quite considerably and generally push us into the amber or green zone. So we'll have a look at an example of that.
Before we do, Paul, I've got a few more questions for you. Do you have any view on how to treat superannuation contributions made on behalf of related parties, for example, a spouse, funded by income from the practice? Is it reasonable to add these back in the calculation of effective tax rate?
Short answer is I have no idea how they're going to treat that. It's certainly not covered. I would have thought, depending on when it comes out, and I guess where it comes out of, if it comes out of the firm, then yes, their entitlement will be less by that amount. If it came out, say the entitlement was to a family trust, and the family trust deducted that amount, I think it's going to be detrimental, because the entitlement from the firm remains at 400,000, but the amount that goes to each individual party is less, and certainly their tax rate is going to be less as a result. But I don't know is the short answer. I don't know how they're going to treat that. It's not covered.
Okay. How do they determine the effective tax rate of the individual when they have income from unrelated multiple sources?
Essentially that, and that therein lies some of the complexity, is determining it needs to be a separate calculation with those undetermined sources removed.
And last one for now, in an incorporated practice, if the company retains profit to, for example, pay off loans and pays company tax, whereas profit that does not go to any individual, how is this dealt with?
It's not dealt with in the PCG. And again, in those circumstances, I would think that is a fairly ordinary circumstance, and it's not one in which what they're really looking for is alienation of income away from the person who works in the firm. If the incorporated practice pays tax, pays down debt, and therefore there is no profit entitlement that goes to the IPP and their group, then that would be outside of the PCG, and I would think acceptable.
Thanks, Paul. I'll let you get back into it.
So example 3, we've got a profit entitlement of 400,000. Nicholas is going to take 180,000 and his spouse is going to take 180,000, and a bucket company is going to take the balance. So in this circumstance, because Nicholas's percentage is 45% of the profit entitlement, we immediately get a score of 5, which puts us in pretty rough territory when on 3 factors we need to stay below 10. So you can see just that change in, that change in percentage, and also the lowering of the firm entitlement quickly increases our scores. So looking at the total effective tax rate, again, once we lower that entitlement, the total effective tax rate becomes lower. And as the Tax Institute pointed out, one of the aspects that is not covered is lower tax rates in general from when, I guess, the suspended guidelines were introduced, and also lower company tax rates if they might apply if a distribution, for example, went to a company on a lower tax rate. So you can see from the calculation here, we've got a score of 28% as a total effective tax rate. And again, once we drop below that 30%, our scores go high. We're currently at 9. And Nicholas has determined that his $180,000 is 100% of the benchmark remuneration, which gives us a score of 4, which I would say, I guess that step by itself would have been low risk under the suspended guidelines, and no other test needed to be applied. But under these guidelines, or this PCG, we are currently sitting well within the red zone. I have said it a few times, but I hope I can underscore, the lower that profit entitlement gets, the harder it is to pass these tests. So what could we do to put Nicholas back into the green zone? So in this circumstance, he would need to return in his returns at least 60.01% of the profit entitlement from the firm. And I say 60.01 because if you go at 60%, you add on 1 point to that, to RAF score 1. So that pushes us up into the amber zone, which then comes with added compliance activity. So you can see, I guess, that the complexity that has been brought with this new PCG will require yearly and forward planning every year, discussions on what that profit entitlement looks like, how much would be returned in the hands of the IPP, and whether they are prepared to sit higher than or in the amber or the red zone, and provide an explanation as to why. Because going back to the beginning, even though it sounds very scary to sit in the red zone, there may be very genuine commercial or other reasons that are present that mean that Part 4A doesn't apply. This is only a circumstance where greater compliance activity will be given to those in the red zone, but also it will be a circumstance when they look at whether Part 4A might apply. So the ATO compliance approach, if you're in the green zone, it's that they haven't come out and said you're low risk and we're not going to look into you. Essentially, they'll look into you if they're not satisfied with your assessment. Well, that makes sense. Or they're aware that high risk features are present, or they're concerned about, I guess, your previous compliance history with other areas, Division 7A, for example, or they're looking at you for other reasons. Again, Division 7A, they may then look into this even though you are in the green zone. In the amber zone, they're likely to conduct further analysis on the arrangement, and that may lead to, obviously, audit, and they may contact you to understand what your arrangements are and why you're in that amber zone. If you're in the red zone, they're likely to review you as a matter of priority, and then the case, I guess, your circumstances may lead directly to audit rather than even having an inquiry stage. And they are likely to use formal powers to collect information from you. Obviously, being in that red zone comes with, I guess, greater visibility by the ATO, and that's something. It was said to me by an accountant who's in practice in a practice structure with a number of other accountants, and it was said to me, well, why would the circumstances of another practitioner impinge on, I guess, our business? And the answer is, if that individual practitioner sits within the red zone, then the business may come under audit, or at least questions, because that tends to be how audits start. It may be on the IPP, then it may be, I guess, leach into the actual business itself. So for that reason, I think, and many others, it's garnered some fairly serious criticism from a lot of industry bodies. In fact, there's about 12 or 13 industry bodies, all accounting bodies, put in a joint submission, effectively, decrying the changes that are being made.
Thanks, Paul. I'll just jump in for a sec. Your answer there, or your comments there, just shortcut a question there from one of the participants about what would happen if one practitioner got audited. I mean, the reality is the other ones are likely to get audited as well as the business, and certainly personal experience tells me that. Another question: even if in the red zone, the commissioner still has to get Part 4A over the line in court. These rules seem fairly arbitrary. Can you project on how the court will react? I'll answer that one for you, Paul. We can never project how the court will react because you're always surprised about how they react. However, as Paul mentioned at the beginning, this is the commissioner's view. It is not the law. The idea or the concept of treating one form of income differently because it is from a professional services firm is completely against case law to date. So I would think unless you're really out there with no documentation and very strange affairs, I would think it unlikely that the commissioner would win a Part 4A argument with most professional practice structures. And one final question, Paul, before I sign off. Do we have any clues yet on how the ATO are going to know what we've self-assessed?
No, we don't. Sorry.
That's all right. I'll let you get back to it.
Thank you. So this is my last slide, and it probably covers a couple of those questions that Adrian just went through. So when I do this paper again, I might add a slide in. But essentially what this does is if you sit within the red zone and you get audited, it then puts you on the usual path where a scheme might be identified to which Part 4A might apply. So that is obviously audit, a position paper. They will put the matter to the General Anti-Avoidance Rules Panel, which you have the ability to address. Generally, that's a rubber stamp for the audit team, but those normal processes will then unfold. It's not a matter of saying you're in the red zone, they're going to apply Part 4A. No, the answer is that you're going to have to explain why your circumstance, or I guess why you've implemented your circumstances, and why Part 4A doesn't apply or should not apply in those circumstances. What the PCG doesn't consider at all is the sole or dominant purpose test. And again, that Purcell's case that I talked about earlier. It doesn't cover that aspect. And one of the criticisms that we and others have is that the guidelines, as I'll use the questioner's phrase, seem arbitrary, and they're not directed towards the factors outlined in Section 177D of the 36 Act, which outlines the factors to which that have to be addressed in applying Part 4A. So there may be one or two of them, but on the whole, those factors are not addressed by this. They've picked three arbitrary, rules-based areas where they think people from professional services firms should fit within. And that, again, as Adrian said, is not dealt with in other industries. So we can't understand why professionals are placed in that same in a different category, a special class for special attention. Again, it's not the law. It's simply a guide for when the commissioner might apply Part 4A. Evidence of your intention is always important whenever you're doing any, transaction that has a tax outcome, so that you can assist the court if it ever got to that, to say that, well, the sole or dominant purpose was not tax avoidance, it was X, whatever that is. Someone asked me yesterday, do you think this will get up, or be published in final? And my answer to them was, I think this is significantly different to a tax ruling, for example, albeit that they have sole authority to put out a tax ruling. This is a guideline to internal ATO officers. It's not out there as, I guess, in the same way that a tax ruling is. It's really about an administrative guidance for when ATO officers should consider Part 4A. On that basis, I think it will come through. I don't know that there'll be many changes. I think it will be the way that we move forward. So that is the last of my slides. So if you do have any more questions, I'm happy to answer any more. But thank you very much for listening.
Thanks, Paul. Just one that's come through now. Is there any guidance or calculation on what constitutes the entitlement amount?
No, I would have thought. That would be relatively straightforward in that if you're in a unit trust, for example, they would work out the distributable income of that is received in the hands of the IPP, the individual, if they're an individual unit holder, which is probably unlikely, but more in the hands of the discretionary trust, for example, that owns units in the unit trust. So whatever the distributable income of the trust is for that year would be the entitlement of the IPP and their group.
Thanks, Paul. As Paul mentioned, we'll just stay on the line for another 5 minutes or so just to field any further questions. So if you do have them, please feel free to send them through. Just a reminder, next webinar on the 21st of June on property developments and tax issues in relation to them. And for those that are in either Perth or the Gold Coast, we still have Perth has 4 seats left. Gold Coast has a few seats, or 20 odd seats left for our workshops in May. You will be, if you're in those locations and you're listening in our feedback email, you'll have the ability to register from there. Thank you for attending today. In the feedback email as well, there will be the ability to suggest topics. We're always happy to take on those suggestions. So Paul, I'll just stay on the line for a little while and wait to see if there are any other further queries. Paul, do you want to answer just those couple of questions, or are you happy for me to?
Sure. No, I can.
Okay.
So there's a question there about where you can find a benchmark amount. All the PCG says is essentially if there is a benchmarking authority. I don't know where you would find a benchmark amount for an accountant or a lawyer. There may be somewhere. I don't know the answer to where that is. It simply allows the ability for that benchmark to come out. I don't know. There may be other professional industries that are on awards, for example. I'm not sure.
I think you might, probably the best you could do would be to rely on those salary surveys that circulate.
Yep. That'd be a good one. Does it include salary or super paid to the IPP by the unit trust? Yes, I think it would, because that is actually, I'll pull that. If it is a salary, that is probably different to an entitlement to professional firm income. It doesn't really, the PCG doesn't talk about salary or super at all in terms of whether that is included. Thinking on the spot, it probably will, even though I've gone between the two, because that is an entitlement from the profits of the firm. Yeah, it's a bit difficult to answer because it really doesn't talk about salary at all. That may be something that fleshes out in the future. Sorry for that really convoluted answer. Is that all, Adrian? Thank you, everyone. We're going to shut off now. Cheers.